Thank you, Netta. Hi, everyone. I'm Regina Korossy, and as a financial advisor and accredited asset management specialist, my goal is to help clients navigate the uncertainty and help them achieve their goals. And we have had no shortage of uncertainty this year. 2020 has been an unprecedented year, no doubt. And on top of the year's events, it also happened to include a US presidential election. Now, you've probably heard quite a bit of commentary and speculation about what impact the results of the election are going to have on our lives. Presidential elections are always a hot button for headlines and investment. However, this time we're also dealing with the unprecedented COVID-19 pandemic, the resulting recession, and the emerging, albeit slow, recovery. So like many Americans, you may wonder how the election's outcome could affect the financial markets, your personal portfolio, and the progress you're making towards your goals, as well as how it relates to your strategies as fiduciaries of your HOAs. You may also wonder whether you should change your investment strategy based on the election results. Now, although changes in government policies can have an effect on investment returns, they're actually much harder to predict than you might think. And the consequences of policy changes are usually not as expected. So let's start today by taking a step back for some perspective. Here's what the stock market has looked like over the last 90 years. Now, this chart represents every single war, every presidential election, every financial crisis, and every recession since 1929. And as you can see from the dark gray mountain, that the stock market has always recovered. In fact, markets have performed well amid a wide range of conditions in challenging periods: high interest rates, low interest rates, shifting global conditions, and changing political environments. Even during the 1930s, which was one of the worst decades for stocks, the stock market basically broke even. So you may ask, if the stock market has recovered 100% of the time, what causes the average investor to panic and sell? So this is where we look at the psychology of investing. And we have learned over the last 100 years that market sell-offs are fed by two things: fear and uncertainty, and our reflexive nature and reaction to that fear and uncertainty. Now, no matter who I'm working with, it could be HOA boards, business owners, individual investors, I often say that one of the most important services I provide my clients is really saving them from themselves. Because money taps into the emotional part of our brain called the amygdala, which is what triggers our fight or flight response. Whereas we should be making decisions with a different part of our brain called the prefrontal cortex, where our rational and our deliberate thought comes from. And it's this fight or flight response that can cause us to make bad decisions during emotional times in our lives. It's the same emotional trigger that can cause those going through something traumatic, such as a divorce or the loss of a loved one, or say a global pandemic, to make cognitive and emotional errors which may result in bad decisions. But the good news is this can be remedied with two things as well: awareness and education. So in March, the stock market dropped 34% in what has been the most abrupt and also the shortest bear market in history. And as an example, if we look back to the last time that the market dropped more than 30%, it would be back in 2009. When we saw market headlines such as these. Not unlike some of the headlines you may have seen since March. And these headlines are meant to evoke an emotional reaction and to grab your attention. That's the point. So in 2009, the investors who reacted emotionally and pulled their money out of the stock market missed out on the largest rebound in history. Similarly, the market dropped 34% in March and has since bounced back about 60%, resulting in the shortest bear market in history. And so this reminds us that although history may not always repeat itself, it certainly does rhyme. So even though we can't predict the future and we can't time the market, history can provide us with some helpful context. For example, you may be surprised to learn that historically, the stock market has returned about 14% during election years and under every political combination in Washington, providing an annual average return of 8% per year. In other words, the economy has grown regardless of who controlled the White House and Congress. This table also shows us that the stock market and the economy have performed better under Democratic presidents. They've also performed better when Democrats held the majority in Congress. However, inflation has been lower during Republican presidencies and congressional majorities, which directly affects the bond markets. Now, it might be tempting to think these differences will continue, but that can be dangerous to your nest egg to try to predict what's going to happen in the financial markets based on what's happened in Washington. A more powerful driver of market performance over time is the broader economic backdrop. So with that in mind, here are some key trends you should know and keep in mind when it comes to politics and investing. Remember how I said that emotions can drive some investors to make bad decisions? That means that these knee-jerk reactions to election outcomes are often misleading. But that does not prevent the media from piggybacking, magnifying, and speculating on those knee-jerk reactions with some alarming and eye-catching headlines. So for example, looking back at past election outcomes, stocks initially dipped about 5% after Obama's 2008 win and about 2% after his 2012 victory. Stocks also declined 4% in the early hours after Trump's victory in 2016. But all of these post-election dips proved to be short-lived, with stocks quickly reversing their course. In fact, since 1947, the S&P 500 has climbed 6% on average in the 12 months following a presidential election, which is about the same percentage as the 12 months preceding an election. So here's another view of the stock market, and this time with the two political parties overlaid in red and blue. When we look historically at an incumbent Republican Party being replaced by a Democratic Party in the Oval Office, the market averaged a return of 14% the following year, compared to 8.6% when an incumbent Republican stayed in office. In fact, you would not be able to name a single president under which the stock market has not increased. So the key takeaway here is that the stock market doesn't win or lose on or just post-election day and has performed well following a wide variety of election outcomes. It's also important to remember that the stock market is not the economy, but rather a reflection of consumer confidence. And consumer confidence is often tied to partisan views. However, it's consumer spending that drives 2/3 of economic growth in our country. So when consumers feel confident, they're willing to spend more, and that spending boosts demand and economic growth. This chart shows that consumers tend to have more confidence about the economy when their preferred party is in office. Not surprising. Democrats expressed higher levels of confidence between 2008 and 2016 with President Obama, and Republicans have reported higher levels of confidence under President Trump. Independents tend to exhibit confidence at levels between the two political parties. So even though Trump and Biden have very different approaches when it comes to key policies such as taxes, regulation, and the government's role in economic growth, it's important to remember that this is not new or unique to this specific election, even though these differing views are more heightened given the existing pandemic and current political environment. Also, often what is said during the campaign trail differs from what actually becomes legislation. No administration solely determines the fate of the economy or the financial markets. While changes in tax policies can be unpredictable over time, today taxes are at historically low levels, and the government deficit has increased substantially as a result of the pandemic and our government's response to it. So that means it is not unreasonable to expect taxes to rise at some point in the near or distant future. And that just presents opportunities to discuss strategies with your financial advisor and tax professionals. So the key takeaway here is that even though investor sentiment differs, In each of these time periods on the chart, the stock market increased, growing above 14% during the first and second Obama terms and about 12% under Trump. Now, as we recorded this presentation on November 17th, in the weeks following Biden's win, the stock market reached record-breaking highs. So, since consumer spending is the largest component of our GDP and it relies heavily on consumer sentiment, now more than ever, it's the economic and corporate conditions that matter much more than politics. The trillions of dollars in monetary and fiscal stimuli in response to the pandemic was the most aggressive government response in our nation's history, and it occurred sooner than in any other recession ever. And it's this monetary and fiscal easement that served as a much-needed bridge for our economy and will continue to be a key component of the economy for some time in the future. The drop in economic activity this year was the largest quarterly drop in GDP since the Great Depression, shrinking by about 5% in the first quarter and 31.4% in the second quarter. So the economy started to come out of the slump slowly in the third quarter, due in large part to the federal relief efforts. Additionally, the unemployment rate, which spiked from 4.4% in February of this year to 14.7% in March as a result of the stay-at-home orders and countrywide shutdowns, has been decreasing steadily and was last reported at 6.9% in October. So the key takeaway here and depicted in this graph is that the success, growth, and resiliency of the U.S. economy doesn't change with each election. So just like the fundamentals don't change when it comes to the economy, it's the fundamentals of investing, such as buying quality investments in a well-diversified portfolio, taking into account various sectors, various asset classes, and holding them for the long term. That's what stands up to short-term market uncertainty. It's also important to ensure you have an appropriate type and amount of fixed income investments, which really act as a cushion to equities. So by maintaining the right investment mix to your specific situation, it's going to be much easier to withstand short-term uncertainties and increase your chances for a positive return. And although it may be challenging to stay patient during periods of market volatility, once you have a strategy in place, doing nothing is actually doing something because you're sticking to your strategy. The most valuable asset we have is time, and time is also the most powerful driver of long-term returns. This table shows that a portfolio, which includes a combination of US and international stocks, as well as fixed income, had the highest chance of positive returns over all periods, 100% of the time. So while this election poses unique challenges, politics should not be viewed as a long-term driver of markets. The market doesn't win or lose on election day. Since World War II, the average annual return of the US stock market has been 11%, regardless of which party controls the White House and Congress. Neither administration solely determines the fate of the economy. Although White House policies differ, it's consumer spending and business investment that plays a more significant role in determining market success. The market doesn't have a political party. It's the fundamentals that matter much more than politics. Political changes occur frequently, and your investment timeline will likely span numerous presidential terms. So it's important to make decisions that are aligned with your financial goals rather than election headlines or political parties. So because of this, my advice is don't play politics with your portfolio. Please feel free to reach out to me with any specific questions you may have. I'm happy to discuss your personal financial situation.